Hey everyone, Anthony Venuti here with In Touch Mortgage Solutions. It's Friday, Finance Fridays, and thank you again for clicking on this episode. We're going to be talking a little bit about private mortgages, what they are, what they mean, and what it could mean for the housing market coming this spring. Stay tuned, you don't want to miss this. Over the past several months, the conversation around private mortgages and what it means for Canadians and the housing market have grown as a lot of media coverage is paying close attention to what is happening with private mortgages. Now, I want to thank Ernie from the Team Sess YouTube Real Estate channel, one of the viewers on that channel where we share our videos, for suggesting this topic, something that we were working on. Now, there are a lot of conversations happening on other channels with regards to private mortgages, and I believe it is a conversation worth having as private mortgages did increase in market share over the past year. Now, for individuals to understand what are private mortgages, well, much like the name implies, it is not done through a conventional bank like your top five. Now, there are alternative banks in the B space that do offer products that are very similar or reminiscent of private lending models, but they are not private in all regards. Now, by that I mean private in the sense that when you're looking at a private mortgage that is done through either a syndication or a mortgage investment corporation or even a private individual, the requirements are set by the lender. And common practice in the private space is no GDS or TDS or no total debt servicing ratios are applied. So basically that means the way that a lender would qualify the deal doesn't apply to private lending. The most important thing is the loan to value or the equity in the property. Private lenders generally do not concern themselves with the credit. A lot of private lenders are looking at the return and the equity in the property. Now, what do we mean by that? Well, obviously what the lender is concerned with is what is the home worth and what is the value of the loan and how fast can we sell this home if this person doesn't pay. So as opposed to your conventional banks, your top 5, 6, even the broker-friendly banks and even alternatives, there is a process if an individual misses several mortgage payments, generally 90 days. Well, once that power of sale process is initiated, it could take several months. The difference with a private mortgage is it can take a couple of days if that lender wants to push forward on that path. Now, another key distinguishing factor with private mortgages, as we mentioned, is the speed at which a private mortgage can be approved. A lot of clients back a few years ago when home prices were going parabolic and we definitely saw interest rates much lower, Canadians who didn't qualify through the conventional banking model were forced at maybe the 11th hour to move into a private mortgage. And those mortgages can be officiated anywhere from 24 to 48 hours. We've seen all the ads, fast money very quickly, but it's very important to be cautious because obviously private mortgages come at a cost. Now, there are differences in these classifications. Syndicated mortgages are simply maybe a group of people or 2 or 3 people that have come together. Maybe they are individual, maybe they formed a corporation with a pool of funds, and they single-handedly under that corporation or individually register a title on the property, much like, let's say your conventional bank is in first position, whether that bank is ABC lender. The lenders on a syndicated could be 3 individuals or a corporation. There is a major distinction between a syndication and a mortgage investment company. As a syndication is the share is all allocated to the individuals, either individually or into the corporation. Under a mortgage investment corporation, you actually are putting your trust and faith in the company that you're investing with or the brokerage house that is hosting the funds. So as the name implies, a mortgage investment corporation, those funds are administered by that particular company or that particular brokerage house. And you could be putting in maybe 50, 60, 100,000, maybe 200,000, and that money can be diversified into multiple mortgages. And the registration is part of that business or that corporation. And those are basically administered monthly or whenever your pay cycle is. That money there, you agree on a specific rate of return and they give you that money back every single month, but you really don't know necessarily where your mortgage or where your funds are invested. So there is a pooling system, there's a syndication, and then there's a very popular one that has grown significantly over the past few years, which is the private individual. That could be an individual in their personal name or under their own corporation who basically has all the funds required to complete a mortgage. So for example, much like your institutional bank, you need a $500,000 mortgage. Well, and you're not able to qualify with them or an alternative lender, you might go to John Smith. John Smith lends you out the money, and the title is registered under Smith Corporation, for example. So you can see that there's a little bit of a difference between how these are registered. And why this is important is because as we started to see the private individual grow in market share, and because interest rates were significantly lower over the past few years, there's a few things. As the wealth for many Canadians and aging Canadians has grown, the equity in their home has grown. A lot of them may have taken out lines of credits. Many of them may have taken out funds. Maybe they have a significant amount of wealth parked away. Over the past little while, there has been a concern with obviously parking your money in a savings account because you weren't getting that return. And GICs were not paying that aggressively. So many Canadians were looking for better ways to gain a return on their investment, and calling up mortgages or mortgage brokers, letting them know that you have money to invest was very popular. We used to get phone calls almost every single day from private individuals who told us they had multiple funds or multiple hundred thousands or millions of dollars to invest. Now, what happens with these types of individuals? I mean, obviously it depends on their classification of investor. Are they a seasoned investor, someone who's got a multiple hundreds of thousands of dollars or millions of dollars to invest? This is not their total life savings. This is money that they're willing to play with, as opposed to individuals like the mom and pop who had a couple $100,000 available to them, maybe on their line of credit, or they had RSPs, or maybe they had a few $100,000 that they were using right now, and they wanted to get that extra edge. So what happens with these particular individuals, and conversations that we've had with multiple of these types of mom and pop investors, is their designation or their class. Obviously, they cannot just invest this money, or they should not be able to just invest this money unless they meet some particular guidelines. But a lot of people were telling them to take on mortgage investment corporations or put their money to work here. Some clients were just very eager to lend out their money. They were just looking at the rate of return. It was sort of like a FOMO, where they wanted to make this extra money. So long story short, what does it mean? Well, these individuals are now starting to panic. Investors definitely feel the pressures, but they can maybe weather a storm. These private individuals might find it a little bit more challenging to weather some of these downturns. And because of that, maybe they have a line of credit, for example, which they got earlier on at a very low rate. And when prime was at 2.45%, maybe you had an adjustment factor of plus 50 or 1%, or maybe depending on the size of the line of credit, you had maybe at prime. So prime has definitely gone up, and now at 6.70% from 2.45. Obviously, you can see how those monthly obligations would change. And depending on a few different factors, like what that particular private investor lent out their first mortgage at or second mortgage at, maybe was at 6.99, 7.99, and their prime rate is at 6.7 plus 5 or plus 1. Obviously, they might be shortfalling or not even able to cover that payment, and they're realizing the risk to reward is not there. On top of that, they might be running themselves into a situation where they're seeing home prices come down. And depending on what they lent on that home for, the loan to value, if, for example, that person that they lent a mortgage out to, they bought a home for, let's say, $1 million, they put $200,000 down, they had an $800,000 mortgage, and now that home has come down to maybe it's worth $700,000, but the mortgage on the home is $800,000. And because those private mortgages generally are interest only or bearing only interest, there's no principal being paid, and they're short terms like 1 year or 2 years, well, that mortgage might be underwater. And this individual has to now recoup their money. And even if they sell that home, what is the likelihood of them making back their money? So obviously that is the private investor. Mortgage investment corporations are facing similar headwinds as these individuals who parked maybe $50,000, $100,000 in their pool are saying, hey, you know what, now I can get better returns on a GIC, on a savings account, or other investment tools in the market. I want to pull my money out and put it to work in something that's a little bit more secure. And what that means for the investment corporations, these mix, is that if they had maybe multiple millions of dollars in their fund, now basically that is dwindling away. And what that could lead to is that as these mortgages start to come up for renewal, and the funds are starting to deplete, that means that they will not be able to renew a lot of their mortgages depending on the size. And these mortgage investment corporations revolve heavily on new investment in order to make it work. So obviously you can see how this could play out in the marketplace. Now, it's important to understand that some of these investment corps are able to raise capital. Syndications are private individuals who may have a little bit larger appetite to risk. That's not to say that private individuals with multiple millions of dollars or hundreds of thousands of dollars disposable to them will not absorb some of this risk. But because of the fact that a lot of Canadians looked to and make this money very quickly, their appetite for risk is going to be lesser than someone who's a seasoned investor. And this could mean that if these mortgages are not renewed, the mortgage holder, the person that has the private mortgage, the homeowner, will now have to search for a new mortgage product. And as we touched upon earlier, when mortgages were originated last year, interest rates might have been more favorable because even A and B bank rates were sub 4%, A banks were sub 2%, and even privates were starting at 5.99 or 4.99 depending on the deal. But now we're starting to see a significant uptick in those rates as the risk to reward for these investors is less. They want to charge more. So now these clients who might have already found it difficult to make these monthly obligations, even at let's say 4.99, are now facing renewals that are probably 10% plus fees. So that leaves the homeowner in a situation that if they can't find financing with a conventional bank or even an alternative bank, that they're going to be forced into the private space. And if the private space will not renew them, or maybe they can't afford those payments with the new terms, they might be forced to sell their home. Now, obviously, this is a question that we need to keep in mind as we move forward into the spring market. How many individuals are going to be facing these headwinds? And something that's important to touch upon is obviously the type of private mortgages that have been issued. One thing that I want to draw some close attention to is individuals who purchased a home, either whether they've been misguided or were told that they could only qualify for a private mortgage, as opposed to individuals that might have found themselves qualified by a bank or alternative lender, but due to an unforeseen circumstance entered into a private mortgage because they still qualified. They just had maybe one item that was not allowing them to qualify with those banks and had to go private. Because there is a big distinction between individuals during the FOMO era of home prices when they went parabolic and interest rates were lower to get into the housing market, because a lot of them believed that if they didn't do it at that time that they wouldn't get in. So a lot of people were persuaded to take on private mortgages. And that was a very risky move, and something that I touched upon a little bit earlier that I think should be something relevant, why I believe mortgage brokers have a definite requirement, a fiduciary duty to their clients. One thing we've been talking with these clients, and I said with so many different agents and professionals out there, some that I wouldn't even call professionals, who are just pushing clients into privates because they did not want to collect paperwork. It was just the easiest path, like electricity, the easiest path of resistance. They would just go private, where we were working with clients that, hey, private was definitely an option, but with a little bit more paperwork, they were able to get a favorable rate with a alternative bank, for example, and basically push through, and that the renewals would have been automatic sort of every year or 2 years without substantial fees. There's a difference. A banks, when you go to renew your mortgage, you basically can renew with them, as something we talked about last week. There's alternative banks, there might be a $200-300 renewal fee, which can be negotiated with your broker. So if you have a B bank mortgage, reach out to your mortgage professional ahead of time to have a conversation about that, especially if it's renewing in 2023. But obviously with the private space, those mortgage renewals, if that lender doesn't want to renew, you could be facing another 2-4% lender broker fee to renew those mortgages with those particular lenders. Now, I want to know from your viewers, what do you think should happen in the private mortgage space? Is it something that should be a little bit more regulated? And what do you think OSFI and the Office of the Superintendent of Financial Institutions should do? And I want to hear from your viewers on that topic. Let us know in the comments sections below, but we're gonna leave the video here. I hope you found it interesting or take something away from private mortgages that maybe you didn't know going into this video. And if you do, once again, just don't forget to hit the like, share, and subscribe button and the notification bell. But we'll leave the video here, wishing everyone a great Friday and an even better weekend ahead. Thanks for watching and thanks for clicking.